Hello, folks. Brandon Chapman with you today. It's another edition of Monday Video for TheoTRADE. Markets finished flat as stagflationary moves in bonds and oil opens a golden opportunity. Before we get started and talk about some of the pressures, bullish pressures in gold and oil and bonds today, we're going to take a peek at an upcoming event that we have for anyone that would like to participate. So just so you know, back in November 2nd through 4th, we've got our TheoTRADE. We've got our live event, and it's going to be a great time. We haven't done this literally in 3 years, and we're back by popular demand. That's right. We're back with even bigger and better education with your favorite instructors, amazing sponsors, great food, prizes. It's going to be a phenomenal event if you show up, if you want to come. But sadly, some of you have missed out in booking your room. You got to book it right now, just to let you know. If that's you, just let me scroll down here. You got to book your room right away because you've got till October 3rd to get our killer rate for the hotel room for the live event. And so if you don't have your ticket, boy, what are you waiting for? You'll see our instructors, your pictures, places. So step one, buy the event pass. You got our cocktail party in Paradise, Traders Paradise event, breakfast buffet, everything's at your disposal here. And step two, you got to book your room. Again, you got to do it by October 3rd to get your discounted rate that we've negotiated for you. So again, step one, then step two. If you've already got your ticket, you better book your room by October 3rd to make sure you have a spot at our negotiated rate. And so it's going to be a fun time, a 3-day event, lots of interaction with the instructors, and Don himself will be there. You've got also, if you look at the Tom Sosnoff will be there. Paul Kamut as well from the CME group as well. Anyway, so it's going to be a fun time. Love to see you there at Traders Paradise. Again, November 2nd through 4th. Step one and step two. All you got to do is just go to theotrade.com/23 to be able to get those tickets. Anyway, let's get going. So the what's going on today? The S&P is basically flattish on the session. This is the futures. We're rebounding off the lows a little bit. You look at the top performing sectors, of course, it's energy leading the way as oil prices have continued to rise, up nearly 1.3% today. Now, at some point, this is going to run out of steam, but as of right now, the fundamentals for gold are very strong because gold is in relatively short supply. If we look at the term structure of oil futures, notice how this curve is just getting steeper from where we were on August 1st. All this means is that, look, there's even an increased shortage being priced in right now in oil futures as prices are falling, as the net cost to carry is positive. So the point being is that, look, oil is going to continue to see upward pressure until it doesn't. Now, does that mean that energy stocks are going to fully participate? Stocks do price in the future a little bit more. Is this kind of inflationary climax that leads to recession? It's hard to say. But as you watch the market, and specifically you look at bonds today, 10-year treasury yields in the face of sharply rising oil prices and even further indication of risk to the upside, bonds were bid today. 10-year treasury yields were down slightly. Prices were up. If you look at TLT, TLT recovered off of the intraday lows and finished near the high of the session. This is the same point of found support previously in October and also in August. Again, are we going to recreate the magic here and see rising bond prices and falling yields in the face of rising oil prices? What this conjures up is that stagflationary type outlook that may start to persist in the market. Point being is that higher oil prices may lead to less consumer spending and flagging growth and nearing or approaching recession. This is what we call stagflation, of rising prices and weakening growth. This is a scenario that has historically played out fairly positively for gold. In fact, last week there was significant call option activity out of the money at 184 on September 12th, the day after 9/11, right? The point being is that we're seeing these stagflationary pressures, traders coming in expecting higher gold prices. We also saw significant option activity in GDX last week. Well, guess what? We saw significant call activity in gold today, GLD. We saw it in GDX, which was the sector or industry gold ETF. We also saw it in an individual name called SA, with the symbol SA. So we look at GLD today, the option activity centered on which strike here. If we go into a 6 oct, just scroll down here, you see 26,000 contracts, mostly bought out of the money at 181.50. So look at 181.50. That gets us just above the prior high on September 1. Now, an interesting way to trade this is if you look at, just go out, let's say 32 days, notice that the implied volatility for the out of the money calls is very flat. You could construct like a 180, 181.50, 182, and you can do it where you're buying a lower implied volatility and selling a higher implied volatility. That will give you better than one-to-one risk and reward to risk. For example, this 180, 150 might cost you like 66, 67 cents, or you can stretch it higher if you want, or you can keep it closer. The flexibility here is that because the curve is so flat and rising, you can buy the lower strike and sell the higher strike and construct a reasonably priced spread to capitalize on gold's move to 181. Well, maybe it might even go higher. If we take this as a seed wave right here, noticing we gave back about 61% of that move. I'm going to remove that drawing. If we were to draw a fib projection as the seed wave right here, again, 138.2 is 183.50 to 185. And then the next target's up here at 188 to 191. Point being is if we continue to see rising oil prices and pressuring a weaker dollar, and at the same time seeing Treasury bid, this benefits gold. It's a stagflationary type expectation, and gold could really see a nice move here, even bigger than the prior move we saw in August. Again, we saw, for example, last March, we saw similar dynamics, really pushing gold as the dollar weakened. And this is the same setup we may be seeing here with temporary strength in treasuries, strength in oil, leading to, as a weaker dollar pushes gold higher in relative terms. And as we look at GDX, the trade today in GDX at resistance going back to August 30th. Again, we saw bullish activity off of the lows here on the 14th, popped up on Friday, kind of held on today only at 0.1%. But GDX, this was a December expiration, so we're out here just a little bit, but the December expiration out of the money at 36, mostly bought. Again, looking at upside in gold stocks, 36 gets you back to the prior high from April, May by December. Now, again, you could expect to see some movement in the near term, even looking at something like in October. And again, the vol structure being fairly flat in here does allow you to construct an upside call spread out of the money, 30.5, buy the 30.5, sell the 32.5. Maybe it costs you, 45, 50 cents. You can maybe sell the 31.5 if you want a tighter distance. Again, what's happening here is the vol is pretty flat, so you're not being penalized by doing an upside call spread, just trying to benefit by gold or GDX, gold stocks going back to the prior high at around around 33. Top holdings in this one is Barrick Gold, for example, and also Newmont, so NEM. So both these stocks could participate, but sometimes it's the smaller companies fueling the rally, stocks like Seabridge. Now, Seabridge itself is not especially liquid. Wider spreads in here, so preference would probably be to trade GDX over Seabridge, but you could potentially buy the stock. But today's trade in Seabridge was a December expiration, again, looking out of the money at the 15 strike. So we're talking about some relatively big moves being priced in today in some gold stocks. For example, on Seabridge, if you bought at $11.89, you got to risk about $1 to possibly make $3 to $4 if you're right. It's a pretty nice reward to risk. But again, if you're trying to eliminate some of the market risk, going to GLD works as well. So a lot of different choices of directions you could take. But again, rising oil prices puts pressure on the Fed, right? Puts pressure on the dollar possibly, right? As we look at treasury prices, treasury yields falling. Again, gold is a negative yielding asset. So to have that competitor yielding higher prices and lower yields does make gold, or helps boost gold with falling treasury yields. So if we can get that dynamic, Oil prices continues to put pressure while yields are falling. We build this stagflationary outlook that could be very positive for gold here in the near term before any sort of major market sell-off. And by the way, if gold outperforms the S&P 500, we'll just do a ratio of SPY to gold. Notice this is breaking to the downside the last couple of days. If gold is rising while the S&P is flat or underperforming or declining, again, this stagflation outlook ultimately provides a bearish signal for the overall market, especially if you add into the mix relative strength in the dollar against foreign currencies. So if we can hold up in here in the dollar, gold continues to surge, S&P underperforms, that is a situation that generally yields lower prices in the S&P 500 in the near term. And last week, we did hit a pretty significant level on the 3-month to 1-month VIX, hitting 1.196, meaning what? The 3-month VIX was 20% higher than the spot VIX. That was on Thursday. We saw skew rise to 144.5 on Thursday. Friday, it dropped just a little bit to 143. The scenario is setting up rather bearishly for the market. We can see if it can deliver, but gold strength in the near term before we start to see a major pullback in the market, gold generally does well and outperforms the S&P 500. Now, with rising gold prices, it continues to put pressure on airline stocks. Jets today is down nearly 2%. As you can see, we consolidated for several days and breaking out today. There was some bullish call activity that came in on Jets on the 15th. But there is continued to be bearish activity in like Delta and American. But today's breakout with higher oil prices looks like we want to test our lows at 17 for the airline space. Occidental Petroleum, again, bullish movement in oil. What does this do for stocks like Oxy? It was a pretty sketchy day where we gapped up on the open, sold off, and recovered about halfway into the close. Be careful right now with oil, right? Oil is very extended. Oil stocks may begin to price in the potential. Oil prices could see a correction. And so oil prices have a tendency to run into the buzzsaw of selling. And this backwardation is going to continue to put pressure. But again, expect to see energy shares, at least right now. They may lag a little bit due to the extended nature. But oil prices may continue to put pressure or heat on that inflationary outlook, as the supply is very uncertain or is low right now. Let's take a look at WBA and CVS. So this is kind of more of a healthcare-oriented play. Again, they're in the pharmaceutical space, retail. They also do some healthcare-related business as well. But Walgreens Boots Alliance came off our lows, ended up closing above the low on the 14th. You can see we're kind of boxed in here just a little bit based on the high and low. But today's trade in Walgreens Boots Alliance and CVS came in on the bearish end of things. So today for WBA, it was a weekly option out here, 4,100 contracts traded out of the money. So looking at a 21 target here in the near term, could reasonably reach that this week. Again, you could think about even an in-out spread type trade, buying the 22.50, selling the 21.5, 1 point wide, maybe cost you about 40 cents. Not a bad scenario. The vol skew is favorable. You're buying the lower vol, selling the higher vol, looking at a target of about 21.5 to 21 in the near term. Now, that would be just for this week, 4 days. Maybe even better yet, go out 30 days, right? Give yourself more time for it to get it. And it doesn't really cost all that much more money. Buy at 89, sell at 50. Again, I'm just kind of using this approximation for the mid. But anyway, cost you maybe 40 cents on a $1 wide spread, needing this thing to get to 21 in 30 plus days. CVS, another one here. So CVS popped a little over a week ago. We're consolidating right now. We did fade from the high a little bit. Look for maybe trading through the lows at 70, or the lows right here at close to 70. And CVS, the bearish trade today was on a 22 SEP. Again, this week, 7,000 contracts at the 70 strike, buying the, sorry, actually it was 3,000 something, but buying the 70 and selling the 68. So buying the 20.7% implied volatility, selling the 26.7. So it's a pretty nice little steep skew here. These out of the money puts are relatively expensive. So it could construct a long put vertical for maybe about 25 cents. And if you look down here at the time and sales today, you can see kind of the scenario that did play out for the 22 SEP expiration. See spread in here, right here. We're buying what? We're buying the 70, selling the 68. The net difference there is about 34 cents. So again, the 7 cents helps reduce the cost by selling the out of the money, but 68 is only right here. So we're looking for a pullback into this range. If we quickly test the lows, you could get out of that spread for not max gain, but get a decent chunk of the max gain out of that potential trade. So again, a couple of interesting trades today. They're based on what? A lot of them are based on the movement in oil and bonds. And then secondarily, we have an area of the market that saw some coincidence of activity, bearish activity in the case of WBA and CVS. So both pointing to the downside. So some interesting looking trades setting up today for this week. So again, watch the market this week. Feel free to go to our page, TheoTRADE.com/23. Have a chance to attend our live event coming up November. We would love to have you there. But remember, step 1 and 2, book your room, buy your ticket if you haven't, or vice versa. Anyway, love to see you there.